joined by Abhay Agarwal of Piper Serica, just to understand what exactly has changed in the overseas ecosystem, which may impact. We are hesitating to really participate in a full-blown fall right now, but it is potent enough, is it not, Abhay? The rising of yields so sharply to levels last seen 15 years back, dollar index 105 upwards. Uh, why is it prudent to be slightly cautious right now? And what were the signs you were watching out for after which you actually turned cautious?
No, thank you so much, Ajay, for having me on the show. Good afternoon to you and all your viewers. I think what has surprised me in the last 2 weeks, if I would say, is just the stickiness of the US, govies as they are called, the treasuries, the bond yields. If I see the 2-year bond yield well over 5% now, 5.2% almost. As you said, 10-year bond yields, US bond yields are at 16-year high, more than, almost at the GFC crisis level. And they are not stopping, Ajay. It's so my fear now, Ajay, is that there is a credit, event that could take place. It may not, but the signs are that we are headed for a situation where cost of capital for leveraged funds has increased very sharply, especially those that engage in carry trades. There is a spike in cost of capital not only for companies that borrow to invest, but also for investors, global investors who borrow to invest. And this means that at some point of time, there is going to be an unwinding of risk assets. And I think that we are seeing the first signs of that right now. There is a lot of disbelief in the system that says, look, this is a one-off event and very soon the rates will fall because inflation will fall. I don't think that any prudent investor should bet on that because there are signs to the contrary. The signs are that interest rates will continue to go up. The signs are that that liquidity will keep getting squeezed, that there are few takers of US treasuries, unlike earlier when all sovereign governments would buy, China would be a big buyer of US bonds, but doesn't look like anymore. In fact, more people are selling these bonds than buying them. So we could get trapped into a credit spiral, Ajay, and an event, any kind of unforeseen event, a bankruptcy or a blow up in a hedge fund, will turn everybody very cautious and people will run for exits, and the crowded exit will lead to a lot of pain. So that is why I think it's prudent, as you said, Ajay, to maybe turn cautious right now and just wait out for the next month or so.
Abhay, what would you see? I mean, there is also a view that large part of US debt, the current standing debt, actually has been unaffected because of the rate hikes happened there because they were at a tenure. Now the tenure changes and the new rates start applying, a large part of student debt, some real estate as well. So it will start hurting now, so the adjustment of rate hikes in US is still not happened, and that people would want to see how it impacts the lenders universe, this mid, small, regional banks, large bank. Is that a legitimate fear?
I think it's a very legitimate fear, and I'm glad people have that fear because we saw what happened to SVB and some of the other banks that just blew up overnight, because all they did was they said, these bonds that we have been holding at 2.5% when we bought it, now we need to readjust them to 4.5%. And suddenly you find that that loss is large enough to write off your entire net worth and you can't continue your operations. So my worry again, Ajay, is that something you alluded to, that we don't know where these risks are hiding. We don't know right now who is borrowed to the hilt, who may suddenly announce that they are coming clean. And if that event happened of SBB and some of the other regional banks when the interest rates were lower than what they are now, then you can only imagine the stress it will cause to the system at the current levels and if the yields continue to go up. And my bigger fear, Ajay, is that is that a lot of this gets out of control of central banks also. We always believe that there is a put option on the Fed, on the RBI, on BOC and other central banks who will come and bail you out. But there does come a point when that put option doesn't work, and that's when things go haywire. So that is, I'm not saying that it is exactly going to play out as I'm fearing or you are fearing or others are fearing. But as a prudent investor, one should be mindful of this event that has happened, that has changed a lot of underlying assumptions about the stickiness of inflation and rate hike fears.
Abhay, I would want to understand how are you positioning your fund into this kind of a small storm, if you will, which is like appearing on the horizon. If you could share, where all have you booked profit, not only the names at least, but areas which have done very well for you and you have taken some chips off the table.
So Ajay, going into the new financial year, April 1, we were fully invested. We had like 2% cash in the fund. And the bets that we made, mid cap, small cap, we over allocated to them. 75% of our fund was in mid caps and small caps. And thematic plays there, small banks, NBFCs, microfinance companies, textile exporters, domestic consumption companies. And they have that has played out remarkably well, much better than we expected. And since April 1, the portfolio is up almost 40% in absolute terms. Now, as a prudent manager, again, we would like to book some of that profits and redeploy our capital appropriately so that we don't lose the return that we have made in a severe market correction. So what we have done, Ajay, is that we have cut allocations. We have 22 stocks in the portfolio, so roughly 1% to each one of them. And we have exited one mid-cap stock completely. So as of now, Ajay, we have about 23% cash in the portfolio. And we are in no hurry to deploy it. We want to sit on it, do our research, find the next big thing that we can back with conviction. So that's the zone we are going to be. This is not normal for us. We normally don't sit on so much cash. But I think times are such that investors who have made money, especially in the mid and small cap run, to definitely take some chips off the table and redeploy appropriately.
23% cash is almost a quarter of your position. That's quite a disclosure. Abhay, what is your buying list looking like? Which are those names which are there on your list which you've been researching? I think your last purchase was Geo Financials. Would you buy that name if it falls 10% from here, or anything else which you are reading and researching?
Yeah, so again, as a disclosure, Ajay, that stocks that I may mention are not buy recommendations, and we may have them in the portfolio. So with that, yes, Geofinance definitely as a long-term bet. It's not a very large part of the portfolio in our model portfolio. So we are happy to hold it. If it goes down, definitely we will add it. But what we are looking at, Ajay, are some themes that we believe are bottom of the cycle. So we get the benefit of low multiples, low valuation multiples, and at the same time potential high growth as these industries turn around. And one of them, which is a non-consensus trade, is agrochemical space. Both crop protection, crop improvement, farm equipment, and anything that basically makes a farmer more productive, including specialty chemical play there and commodity play also. And a lot of these stocks, Ajay, in mid cap, small cap space, and also large cap space, the listed ones, it is remarkable to see them trade at the same market cap they were 5 to 6 years ago, while they have become leaner and they have become more competitive. And I think one of the reasons is that they have no pricing power for the last 1 year. There's been a dumping happening out of China post-COVID, because China built this large inventory that it needs to get rid of. But I think that dumping is now slowing down. There is some pricing power coming back. There is improvement in the product portfolio, and the valuations are such, Ajay, that a lot of these stocks are trading at a multiple of 9 times, 10 times, historical low multiple. So we believe that this is a space that that would make money for investors over the next 12 to 18 months.
Very fair point, Abhay. Thanks very much for joining us on the show.